Hello and welcome to Switzer Investing. I'm Peter Switzer. Thanks for joining me. And on tonight's show, we work out how worried we should be about the stock market sell-off we're seeing right now. The Nasdaq is down over 23%. The S&P 500 is down over 14%, but the Aussie market is only down a little bit compared to those particular stocks. It's very interesting to see how worried we should be and whether this is a buying opportunity. And I run these sorts of questions by Julia Lee of Boom Invest to see if she's worried, and if not, what stocks is she keen to buy, the safe ones and maybe the more risky ones. I then asked Jun Bei Liu of Tribeca Alpha Plus to do exactly the same thing. How worried is she? What's the safe play? What's the more risky play? That might bring bigger returns in the future, but you might just have to wait for them to come to fruition. Then I talked to the managing director of Xero. This is a company a lot of my experts like. They put out a report on small business. And remember, small business is really, really important to the success of this company. And I try to work out whether our faith in Xero as a really good buy is really worth keeping. And I think you might be impressed with what Joseph Lyons has to say. And then finally, poor Rickard of the Switzer report looks at the sectors that have done well in recent times and the ones that have struggled as a clue to what might be the sectors we should be looking at right now for the future. That's the show. Let's kick off now with Julia Lee of Boom Invest. Thanks for joining us, Julia.
Great to be here, Pete.
Okay, there are a lot of people out there a little bit toey about the stock market right now. I guess if you'd gone really long the Nasdaq, you're really out of the money, down about 23%. Our market's done pretty well compared. We're kind of flattish compared to the US markets. But how worried are you about what you're seeing happening in the stock market now, or do you see it as a potential buying opportunity?
I think when I look at buying in the share market, I like to look at things through cycles. And when we have a look at the economic cycle, you go through phases of recovery, then expansion, and then you have a look at a slowdown and then a downturn before going back into that recovery phase. So I guess investors at the moment are probably hearing terms like late cycle quite a bit. And that's as the economy starts to slow down. And that's the fear at the moment, that we are now going into a slowdown. Not so much a downturn yet, that's probably still ahead of us. So investors are starting to tailor their portfolios late cycle. I guess the question is in terms of timing, how long you're looking at in terms of your investment, on what you do with your investments at this part of the cycle. Generally, for more active investors, the timeframes tend to get shorter and shorter. They're willing to take less longer term risks, and they need to see sort of a payday shorter term. And that's really why a lot of the tech stocks are being hit very hard. Tech stocks are being hit hard, not only because of fears around increasing interest rates, but also fears that we have seen the best growth already in the past, and now we're starting to see slowing growth, an environment where growth is much more difficult to come by. And we've certainly seen that in big mega US stocks, which have driven so much of the return on the US stock market over the last few years. So we've seen some pretty bad share reactions over the past week in stocks like Netflix, as well as Amazon, Robinhood, just to name a few of those stocks. For investors who are interested in what tends to perform well late cycle and through an inflationary environment, the good news for Australian investors is that the Australian market tends to outperform the US. And that's really because of our commodity-based exposure. So I'm still very much overweight in terms of materials. I'd be very underweight or zero weight in things like tech, unless I was looking at just a short-term bounce. And things with higher multiple. Healthcare doesn't tend to perform well a late cycle because it does tend to have higher valuations than the rest of the market as well.
Okay, so give us an idea of what you think might be a safe play for someone who may well be wanting to benefit from the fact that there has been a lot of market overreaction to some stocks.
Yeah, so it depends on whether you're in the market for the short term or the long term. And short term, we're probably likely to see a relief rally in those areas that have been hit hardest, areas like the tech sector as well as the property space and healthcare. However, if you're looking at the medium to long term, it's still likely to be a tough space to be in 2022. I guess for investors, the question is, when do we start to see a turning of the cycle again? The market's already priced in a number of interest rate hikes. And I guess the good news is that the peak interest rate for this cycle is not going to be anywhere near what we've seen in terms of the peak for past cycles. I think the last cycle, interest rates started at 3% and then peaked at 4.75%. Interest rates are going to get nowhere near 4.75% as the official rates here in Australia. The market's pricing in that they'll probably peak at 1.5% sometime next year. And then we'll start to see interest rates coming back down again. So I think it's important to look at the shape of what's expected over the next 12 to 18 months. And for investors, just to have a think about whether they have the risk appetite for the type of volatility that we're seeing over the next 12 months. And don't forget that the market prices in the future. So even before recovery occurs, the market's usually already turned and focus very much on future earnings. So just being aware that this cycle is probably going to be a bit shorter in terms of where and how interest rates peak.
Okay, so name names. Give us some names.
Sure. We saw a really good update from Qantas. I mean, Pete, I've liked Qantas as a recovery story, but the great news is that the recovery is not only on track, but it's actually better than expected, especially in the area of domestic as well as the corporate market. And that means that stocks like corporate travel are probably doing very well as well. And if you have a look at some of the global travel surveys, we know that travel's doing very well in the US as well as Europe. In Australia and New Zealand, it's probably back to around about 80% of the levels it was previously. So there's still a bit more to come. And the reason why Qantas is doing so well is that it predicts that in the fourth quarter capacity, which it was predicting would be at 90 to 100%, is going to be at 105%. So it looks like things are not only going to plan, but better than planned, and that bodes well for the travel stocks and travel stocks like corporate travel as well. I think some of the New Zealand travel stocks are worth a look as well. We've already seen Auckland airport's coming under a lot of pressure, as well as Air New Zealand. So if you're willing to take a little bit more risk, they're probably behind us in terms of opening up and freedom and in terms of travel. But if you want to get in earlier in on that travel story, certainly travel around the globe is heating up. Okay,
is it too late for those people who haven't got any BHP has sold off recently, you've kind of talked up the potential for the sort of stocks you've liked. BHP, does it have more upside? Can it crawl back into the 50s, do you think?
Yeah, I still very much like BHP. It's probably the top holding in our portfolio at the moment. China's come out to say that they're going to speed up infrastructure spending. And I know there's been a lot of concern around China and the zero COVID policy, what that means for growth from China this year. But we also know that after lockdown, things tend to normalize very quickly as well. So, the conditions in China won't last forever, even though they feel like they are at the moment, and we've already started to see recovery in iron ore prices. So today in Asia, iron ore prices were up over 4%, and today in a market that was pretty hard to deal with, BHP shares finished almost flat. So it does look like there's some life coming back to steel making and iron ore over in China. In its key steel making hub, we've seen some of the restrictions being lifted as well. And don't forget that in an inflationary environment, commodities do tend to outperform. So just in terms of global asset allocation, you would expect markets like Australia and the Canadian share market to outperform, and some of the higher growth markets like Japan, Korea, the US to underperform. So I guess Australian investors are in a relatively good place at the moment, because of the commodity space exposure around.
Okay, obviously not every stock in your portfolio is weighted to the same extent as you might, for example, BHP, you got your highest weighting. What lower weighted stock do you think actually has enormous potential to rebound big time, but you don't necessarily think it's going to happen either soon, but you took a bit of a punt on that particular stock?
Well, you know, because I came onto the program earlier on in the year and said I took a nibble at Xero. It is the smallest position in our portfolio, but it's been pretty horrific given the tech sell-off that we've seen. So we're down around about 10% in terms of that position. But luckily it's the smallest position. So I guess the lesson there is just waiting for a stock to rebound before getting in and not catching that falling knife. Having said that, you know, Xero has lots of recurring revenue. I still very much like the business model. And look, a lot of the tech stocks are very much in the same boat where they've all been sold off. I mean, even computer shares selling off at the moment, and that company should do pretty well in a rising interest rate environment. So I do feel like investors are just bailing out of the tech space, no matter what the fundamentals. And that's been hit hard. The other one that's come under a bit of pressure recently is Goodman Group. It's still in an upgrade cycle, but concerns around those rising interest rates are certainly hitting property valuations now on the market as well. So just watching that one carefully.
Okay, you'd be happy to know I interview Joseph Lyons, the MD of Xero, on the program tonight. So you might check that one out.
Tune in.
Yeah, and I must admit, I was happy with what he said. I hold Xero as well.
Very good. That's reassuring. I'll have to listen in on the interview.
Okay, Julia. Thanks for joining us.
Thanks, Pete.
That's Julia Lee, Bowman Invest. Well, joining me now is Jun Bei Liu of Tribeca Alpha Plus. Great to see you, Jun Bei.
Great to see you, Peter. How are you doing?
Very good, very good. But, you know, like a lot of investors, people are a little bit worried about what's going on in the market right now. How would you explain the volatility and negativity we're seeing right now?
Look, it's incredible, isn't it? So the volatility is mainly because the market is adjusting to the higher interest rate expectations. Now, that's important because it makes the money more expensive, and also it makes some of the growth companies look more expensive than what it was in the previous life. So market's going through that transition, and it is creating a bit of volatility. At the same time, many of us didn't quite expect how quickly the interest rate is increasing. You know, we all know interest rate will get higher, but at the moment, because of the inflation, near-term inflation outlook, the interest rate seems to be going higher very, very quickly. So market just going through that adjustment, and that's about it. And from time to time, you have the fear of recession and things, but that is way too bearish for our markets.
Yeah. Now, the interesting thing is, and like, I know you're smart. You've been doing this a long time. And
hopefully.
We know that there's interest rates have increased in the professional market, but central banks really haven't increased interest rates too much yet, but we expect them to do so. Now, but on the other hand, the latest curveball is, well, they're talking recession in the US, which you and I might not believe will happen. But there are plenty of people out there who are telling us there could be a recession. Now, if that's the case, shouldn't we be lowering our expectations of how many interest rate rises might actually happen over the next year or so?
Look, you're absolutely right. Market seems to be oscillating between too much inflation, which means the economy is running super hot, to too much, is potentially going to recession with too much interest rate hike. So it keeps oscillating between one and another. You're absolutely right. It's way too premature to talk about recession at this point, because U.S. economy inflation is running high single digit, and it's a broad-based price pressure, and the wage growth has been high as ever. We're getting a lot of really strong economic data. That's why Fed is putting up interest rate. So let's not go ahead of ourselves. And of course, there's expectations of them putting up interest rate too much. Then what does that mean? But all that is just saying that interest rate needs to go higher quickly. But what happens afterwards, whether we will have a recession, depends on how inflation responds. When it does come off, then the central bank's not going to increase the interest rate as much as it currently is indicating.
Okay. Yeah. Sometimes we get accused, you and me, of being a little too positive, and so But I don't care. Being positive works. 7 or 8 years out of 10, being positive works. But let's just say this. In 3 months' time, the Ukraine war has been settled. Some sort of agreement happens. Let's just imagine, I don't know, it might be 6 months, but let's say 3 months. And in that time, let's say China is totally out of lockdown again, producing stuff, reducing, and potentially the inflation effects from lockdown is dissipating. The energy prices are now not as high because the Ukraine war is over. That could set the scene for a nice comeback of the stock market, surely.
Oh, absolutely. Stock market, even at the current situation, doesn't look too bad. So we have a bit of volatility. You should see the pickup in the next few weeks or so. Look at the share market condition. Yes, interest rate going higher, but we have yet to see all that consecutive rate increase yet. It's just volatility, just market trying to price it in. And then the US, as we said, US economy doing fine, Australia economy doing fine, China in full lockdown, but that stimulus is coming through. So fundamental looks strong. So for share market, actually still looks pretty good for sort of late stage bull market. Now, what's interesting though at this point is the near term, a lot of growth company being sold off. This is when people talk to, oh, we're positive on that. You know, if you actually look at growth company as overall, they tend to look, you know, they underperform, you know, NASDAQ down a lot. But if you actually stripped out the most expensive growth company, the cash burning growth company, they have underperformed significantly. And over the last many interest rate increase cycles, these are the companies that underperform. But the actual underlying stronger, high quality structural growth leaders that generate cash and, you know, have proper business models, they actually do really well and very defensive. So this is actually an environment where, you know, most of the investors sold off all the growth companies. And you can actually pick up the ones that will, that actually have proper, earnings and outlook, things like healthcare, and they will proven to be very, very defensive in the next little phase and will do very, very well.
Okay, so why don't we talk about some companies that you think are safe buys during, you kind of imply it's a buying opportunity for certain companies. What do you think would be companies that would be a safe buy right now?
Absolutely. So if you look at healthcare, that sector is present many opportunities. CSL is the number one opportunity at this point. Share price lagged, but has performed better than some of the tech company clearly. And then the company is going through continued sort of earnings upgrade cycle in the next year or two because its earning was hurt by the COVID disruptions, the blood collection, and all of that. So that earning is expected to be upgraded, and it's on the multiple that is cheaper than what it normally trades on. Look, I think, you know, once the market washed through the next few months, you know, about the high interest rate expectations adjustment, this company will outperform. It will lead the way, and it is a large cap and with, you know, much lower risk compared to some of the speculative businesses. So that one, in my view, is going to do very well.
Okay. Let's go into the thrill-seeking space. Obviously, that's the tech space or the payment space. Is there a company out there that might be worth nibbling along, but on the basis that you might have to wait a year for it to materialise? And I know when I listen and read Cathy Wood of ARC Innovation Fund, a lot of the companies that are being smashed right now, she really believes are great companies if you take a 5-year view and all that sort of stuff. Like a company like Zoom, which we're using right now, I suspect it's going to be a good company in the future, despite the fact it's been smashed in recent times. Is there a local company or two that fit that bill?
Yeah, look, absolutely. If you look at the tech sector, I tend to have a bias towards quality at this stage of the cycle. As we talk to, you know, they're very defensive, and in the next 3 to 6 months, you should see them start being bid up again because they offer their structural growth characteristics. Things like Xero, that's been sold off, that's been, you know, incredibly weak. Although if you look at all indicators about SME ads and conditions, the things are doing pretty well for them. Results coming up, and this is one that we think will do well. And other defensive names, look, that's being sold off. Things like SEK, it should have very, very strong link to our economy. Employment numbers look really strong, so the job seeking numbers look really, really strong. And then it's cheaper than it's ever been. And there's quite a lot of names sitting in those tech space that you should look at. The likes of LTM is looking interesting. Businesses that with proven business model, and they obviously a little bit high risk, but I think if you stick with the leaders that generate cash flow, have proper addressable market, they will do quite well in the next coming 6 months.
Okay, but you'd be interested to know that coming up after you is the managing director of Xero, and after listening to him, a lot of people will probably agree with you as well. Thanks for joining the program, Jun Bei Liu.
Thank you very much.
Joining me now is the MD of Xero, Joseph Lyons. Thanks for coming to the program, Joseph.
Thank you, Peter. Great to meet you.
Yeah, same here, mate. You guys have put out a special report with a very interesting title, Where Opportunity Lies, Australia's New Small Business Boom. Tell us about what this small business boom is about.
Yeah, thanks for the question. I mean, our report does cover what we're seeing as an emerging trend in small business creation. And I think what it does is it really reflects on the last couple of years, but also the industries and regions that we're seeing the largest growth in. And there certainly is a new small business boom that we have seen. And then the report also shares some of the projections around the contribution that we see that small business will make to the economy over the next decade. And then also we unpack what is the kind of changing profile of the new entrepreneur here in Australia.
Well, yeah, I've recently done a number of television special webinars for Optus, and I met a whole lot of new small businesses, and some of them have actually come out of the coronavirus lockdown. So effectively, they were at home locked down, and they've come up with fantastic business ideas, use things like TikTok to get extraordinary exposure. I guess that's part of the boom that you're talking about.
Yeah, absolutely. I mean, it's certainly encouraging to see that many new small businesses that have started up through the pandemic absolutely have technology at their core. Yeah. And we know how important it is, having technology adoption, because it does mean that this next generation of entrepreneurs are setting themselves up right from the start. Yeah.
So obviously the revelations that's in this report, and I'll ask you later how people can access the report, but the news is good for a company like yours, because ultimately Xero caters to small businesses of all sizes. But I think your sweet spot in your early days was fantastically easy to understand for a startup.
Yeah, absolutely. I mean, that's continued to be a core foundation of our business, that we want to create beautiful software that's intuitive and easy to use, and for small businesses to be able to use our platform on the go as well. And, that remains true now, even all these years after that we started up.
Yeah. So looking at the report, what kind of growth are you expecting? Because you referred to that earlier. What kind of growth are you expecting for the total number of small businesses out there?
So it's pretty exciting, because the contribution that we're projecting to see is the growth over the next decade in the small business community is that there will be an additional 3.5 million new small businesses that will be registered by the time we get to 2031. And we're anticipating that these small businesses are going to contribute an additional $60 billion a year to our nation's economy, along with an additional 1 million jobs. So there's some pretty big figures there, but very encouraging for this sector of the community.
Okay, at this point in time, what percentage of small business, and there may well be a rough figure, but what percentage of small businesses is Xero actually got on board as clients?
So here in Australia, we are well north of 1 million customers and subscribers now. It depends on what you're looking at as the addressable market. but we are a sizable percentage of the current small business community. But obviously with this growth, we're expecting to see further growth for our platform as well.
Yeah, a rough figure I have in my head is there's about 2 million SMEs. It may well be a bit bigger, but so you must be getting close to 1 in 2 small business operators are probably using your stuff.
Yeah, I mean, and again, it depends on the size that you're looking at, but yeah, around that figure is what you can expect.
So therefore, if we're anticipating from your numbers another 3 million small business operators, that kind of implies that the potential growth for Xero is quite substantial as well.
Yeah, indeed. I mean, we continue to back the investment that we're putting into our platform so that we make it a compelling proposition, not just for our existing customers, but also for new ones.
What are the greatest barriers for you in getting through to SMEs about the value of working with you guys?
Sorry, play that question back.
Well, what I'm saying is that ultimately the SMEs who have jumped on board with Xero have recognised, your competitive edge in a sense. What are the difficulties in getting that message out to the SMEs who aren't using your product?
Yeah, I mean, that's a good question. We are very fortunate to have a very strong connection to the accounting and bookkeeping industry across the country as well. Our partner community has been a core foundation of Xero from the outset. We continue to remain very focused on supporting the needs of our accountants and bookkeepers, and certainly we've enjoyed the adoption of many new early adopters to Xero, and now we're continuing to work with the entire industry to share with them the benefits of cloud accounting and cloud technology. Equally, we're continuing to invest in our brand so that we can continue to build awareness of Xero in the small business community directly as well. So we're just continuing to build our investment not only in our partner channel and our partner community, but ensuring that small businesses have an understanding and awareness of the benefits of cloud.
Okay, so a lot of people presume that Xero is simply a bookkeeping service, but it's more than that. Do you think the market fully understands the comprehensive other sort of bolt-on services that you guys provide?
There's certainly work to be done there, and as you're aware, like one of the real benefits of Xero is that we are an open platform. We have over 1,000 apps that can plug into Xero in our ecosystem, and addressing a range of different challenges, inventory, point of sale, CRM, etc. So we have a thriving ecosystem of app partners also that we work with very closely to address pain points of specific industry verticals.
Looking at your report, is the growth primarily coming from tech-related businesses, or is there are other sectors that are showing a real low growth? If I'd asked this question 10 years ago, you might have talked about tourism and education businesses likely to grow pretty strongly over that period of time. But are there other sectors that are showing potential?
Yeah, absolutely. I mean, we anticipate that construction is actually going to be the fastest growing industry. We're expecting over 600,000, 624,000 to be precise, new small business customers over the next 10 years. Professional services also playing a really significant part in the growth as well, with almost 500,000 new businesses starting up. And then transport, just over 400,000 as well. So it's not just technology businesses, it's across all industries.
Yeah, as I listen to you, and I know as an employer myself of quite a lot of employees, I know a lot of people want to work from home, and a lot of people are deciding to work from home and set up small businesses in their own right. Is that trend a beneficial trend for Xero as a supplier of those kinds of services that would cater to a new small business?
Yeah, I think it has certainly been a benefit in that our platform is a cloud-based platform, which means that you can access your financial data from any device, anywhere. You don't need to be wedded to a desk or an office like incumbent or legacy desktop software.
Yeah.
So it certainly has been a tailwind or a benefit in ensuring that businesses can maintain their continuity by being in a cloud-based product like Xero.
Okay. Now, Joseph, most of my questions have been around, your observations around small business. I've got one other question, which I want to save it for the end of the interview. But is there any other important observations from this report that people should be aware of?
Yeah, I think we touched on it a bit earlier, but just the sort of the new profile of small business owners that we're seeing, and those that are being brave and taking the leap to starting something new. So what we see now is that, small business owners are increasingly younger. So we now are seeing that 45% of new small business owners are under the age of 35. Over a third of them are far more culturally diverse and having been born overseas. And importantly, we now have over a third of entrepreneurs being women and women that are starting up their business as well, which is fantastic to see. In fact, we've actually seen a 40% increase in new businesses owned by females, which is just wonderful for diversity across our community.
Yeah. This is the question now I want to throw at you. We have a financial services business, and our clients are in Xero. When I'm asked on my TV program, what company do I like, particularly tech company, I always say Xero. And I feel as though the market is not really anticipating the potential growth of the company. I know you can't comment on the share price, but do you think that the market assessment of your company, where it's going, is probably underestimating your potential?
I think we're pretty confident in firstly, just the purpose and the direction of our business. Yes, we started in New Zealand and have had a great growth story in New Zealand and Australia, but equally, we now are expanding our operations across the world, into North America and Canada and the UK and up through Asia. So I think we are excited about, the product that we've got and the value that it brings beyond just the shores of Australia and New Zealand. And I think equally, we've got a wonderful team that work with us and a vibrant culture and community. So I think we've got all the ingredients for continued success.
Okay, well, the link question, going back to where we started from then, given the fact that you are expanding in other countries, I presume you would expect the same kind of small business growth that we're seeing here coming out of things like the lockdown, coming out of all the tech opportunities nowadays. That, I guess, provides opportunities for Xero to grow in those foreign markets.
Yeah, unfortunately, we don't have a report with the same set of data to share with you for other markets, but yeah. I think you can expect to see, a similar trend and pattern following, in markets like North America.
Yeah, because ultimately the idea of the Great Resignation started in America, but we are seeing it here in Australia, despite the fact we employers hoped we wouldn't.
Yeah, indeed.
Joseph, thanks for joining us on the program. Good luck.
Pleasure. Thanks, Peter.
I'm catching up with my colleague Paul Rickard from the Switzer report. And I have a great belief that if you look at where a stock market has been coming from, the strong sectors, it can sometimes give you a clue on what might happen in the future. And ultimately, that's what we're here about. We're trying to work out what are good investments for the future. And Paul is a close analyst of these sorts of sectors. So let's just see what's been going on in the market and all. Paul?
Yeah, I wanted to just go through the highlights. Let's look at the first 4 months of the year. This is still Friday, Peter, but even after today, the basic numbers are still there. So the market's flat. Okay, after today, it's down about 1.2%. But with dividends, it was up very marginally at the end of April, now basically flat. So that's not bad given what's happened in the US.
That's right. NASDAQ's down like 23%, S&P 500 down 14%. So our market's really been strong this year.
Yeah, and the highlight of this chart, perhaps, Peter, is that what we're seeing is really the drivers coming out of the major stocks. So it's the top 20, it's really the banks, the resource companies plus Woodside, plus Macquarie. They're the stocks that are adding to the market performance. And it's sort of the some of the other sectors which is dragging it, but the top 20 up, the small caps and mid caps are both down year to date. So that's an important thing to note. Let's look at the sectors, and these are the 11 ASX industry sectors, both the month of April, but also for the 4 months ending the 29th of April.
Yeah.
The positives in green, you can see that's resources, so energy, no surprises there. That's your Woodside, your Santos. We can't be surprised given what's happened to the price of oil post the outbreak of war in Ukraine. Plus materials, that's probably the really big number, and that's your BHPs, your Fortescues and your Rios. Also some of the second tier minerals, your South 32s, probably a bit of impact of some positives in some of the the lithiums and so forth.
And rare earths, Lyons.
Yeah, gold's probably not a huge contributor, which is might surprise some people. But
its time might lie ahead.
It's my time. And also you've got companies in there, it's not just resources. We've got things like building materials. So companies like Amcor, Aurora, Boral. Amcor's a positive, the other two are probably negative. So that's the second sector. And then I guess the third one, let's not talk about utilities, that's too small, but that's just power prices. But let's look at the negatives. And there are all the high growth sectors, which again won't come as a surprise. First of all, the IT sector off 22.7%.
Yeah, that's the tech stocks.
And they're a lot worse than that. There are some tech companies down 70, 80%. There are positives though, a company like ComputerShare, which is all classified as part of that sector. That's actually up year to date. So it's not totally every tech company or every company in that sector, but most. And the other sectors that are negative are, again, healthcare, which in Australia is not really a defensive sector. We see that more as a growth sector, and that, of course, is perhaps just, again, a question of multiples. And consumer discretionary, where you've got some high flyers in that sector that have also been sort of hit. So it's the impact of higher interest rates on the one hand pushing up materials, on the one hand helping the financials, which is a positive, the biggest sector up 4.6%. On the negative side, you've got IT, consumer discretionary and healthcare.
Let's try to make some sense of this, Paul. And I'm doing it from a point of view of what might be the sectors that do well in the future. Now, I think it's totally understandable that consumer discretionary should go off the boil, because we know Harvey Norman, JB Hi-Fi, they killed them during the lockdown period. We're out now. So people are starting to look for services, and people are desperate to go overseas and things like that. Where would the travel companies be in that group?
Well, some of those are, Qantas is in industrials, which is always a bit strange, but some of the ones you mentioned, like the flight centres, the webjets, they're actually in consumer discretionary.
Yeah, that's right.
So you get a bit mixed up. The sector classifications...
Which means that's the part that could actually help discretionary going forward.
Yeah, the other thing that's going against consumer discretionary, you've got all the casinos have largely been in trouble, Crown, Star, and Aristocrat Leisure is probably the biggest one there, which had a takeover of a company in Europe, and of course that fell through. That was Playtech. That's come down a long way. So there were some pretty expensive, pretty big multiple companies that have come back. And that's why that sector. Yeah. So I think if you say, well, so what? This is history. Does history repeat itself? I still think we're in the market which is going to be led by financials and resources.
Yeah, me too. And
because they're the biggest sectors, Peter, when institutions are having to put money into those sectors, they're not buying anything else. And that's really why it's really hard for sectors like in the short term, IT and some of the neglected sectors really to make much of an inroad.
So it seems to me then, Paul, that like those ones like energy, resources, and financials, they have upside, but they probably don't have massive upside because they've already been for big runs. To me, the sector worth having a go at, because it's made up of a lot of solid companies, the healthcare sector. And the CSL is a classic case that I like in that group. But if you're a thrill seeker, you're going to go looking at tech companies, but you may well have to wait a year or more before you really feel satisfied that was a sensible investment.
I think tech companies have got a lot of work in front of them, Pete. There's some super bargains out there, but you're going to have to be really patient, and you got to be fearful when others are greedy. Whatever what the Buffett phrase is,
Yeah.
right? And you're going to have to be the reverse of that, right? You're going to have to be really greedy, and you're going to have to do a lot of pain, I suspect.
Yeah, I guess the interesting thing, Paul, is at least you can get some of these companies that once upon a time were regarded fantastically at very low prices, but it's going to be a waiting game.
Yeah, and I think, look, the healthcare, of those sectors that are in the red on the right-hand side, and we know that there is always reversion, right? We also know that there's rotation, right?
Yeah.
And
The two R's, reversion and rotation.
Yeah, and it's rare that the best sector one year is the best sector the following year and vice versa. In fact, IT was the best sector in 2019 and 2020,
Yeah.
right? And it's got the wrath late last year,
Yeah.
and it's the worst sector this year, right? That's what happens. Healthcare has been a great sector for a decade. Yeah, it's been a bit tough for the last year and a half since really COVID came and we got the vaccination. It's sort of been once you had that sort of boom. So, I think healthcare is probably the one I like to look at, simply because the demographic and some of the tailwinds are still there. But again, the market is still sort of seeing as high growth, and so that's being a bit negative. So that's probably the one that stands out for me. But I don't like there is real estate, Peter, and I don't know why that's not doing worse. But and I think I look at everything around that in terms of higher interest rates, which should be a negative. I look at what's going on in CBD offices.
Yeah.
I just can't. I know we had an enormous lot of money came into it because cap rates or capitalisation rates went down, which drove it up. I just can't believe that's sustainable. So that's the one that scares me. But it's up in the month of April and it's only down 5.8. But that's probably the one I wouldn't look at. Healthcare, I think, and IT, but you have to be really patient on the IT, I suspect.
Yeah. One's healthcare is for the safer person, and the IT is for the thrill seeker. Thanks, Paul. Paul Rickard of the Switzer Report. And that's the show for this week. Thanks for joining us. Don't forget, if you want to know more about stocks that you could think widely about, have a look at our Switzer Report. Go to switzerreport.com.au. Thanks for joining us. See you on Thursday.